Let's take a look at how the Asian markets are faring. They had opened slightly higher with a positive bias after the drop that they saw on Friday.
And the consideration for this one is around 597 crore rupees as per the company. Here's the first take on the index this morning. It's a flat with a bit of a positive bias.
The last few weeks have been good for the markets in general.
I would say about, for this year, another 400 to 500 crores worth of orders. The pipeline is there.
Remember, the FTSE number MBA, this particular review was mainly aimed at companies, that were either IPOs or spin-offs.
It's a quiet start so far, but things appear to be picking up.
A new CEO, interim CEO, was then put in charge then.
As far as the markets are concerned, continues to be lower, but there is a recovery which is underway.
Good afternoon. Welcome to Closing Bell live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me are Surbhi Upadhyay and Nigel D'Souza. It's been a quiet day, right?
Yeah.
I think we're still soaking in after what happened yesterday. Markets are just a little comatose.
I would actually say that this is probably not so bad because remember, right, about the time when we were anchoring between 11 and 12,
there was a sharp
the market
slide,
broke below 19,700 and you're wondering what's going to happen next. But at least from that level, we've pulled back and we're back in the day's range for what it's worth.
So the range has been fairly tight, right? On the Nifty, it's been close to about 80, 90 points. On the banking index, the Nifty banking index, it's been a range of close to about 260 points. Sorry, but keep your eye on the mid-cap index. The mid-cap index is completely flattened out from the day's high. And today, the Nifty mid-cap index went on to hit a fresh high. It conquered that 42,000 mark on an intraday basis. The high today is 42,011. So from that level, the mid-cap index has given up close to about 180 points. We're not at the day's low, but we're closer to the day's low. IT is holding up well. The Nifty IT index is up close to about 0.5%. So the good run in IT continues. And you've got names like Latent View. Pull up the intraday chart of Latent View, and you've got the sudden surprise surge coming through in a stock like Latent View. Even Cyient, for instance. Cyient is an ER&D player, so in a way a competitor to Tata Technology, and that's seen a fair amount of buying, 5.5% on that.
And I guess when you have a new listing, new buzz, investors looking at that sector with a fresh set of eyes and anticipation, maybe just excitement. But overall, I guess, Reema, it is actually your sector in IT which is keeping the flag up for the Nifty. Otherwise, it's a weak day. The Bank Nifty hasn't really performed. Best case is that it hasn't collapsed. At least after Friday's drubbing, we are seeing the Bank Nifty also hold that range. Though, as I said, there was this intraday sharp dip around 11:30, but the dip got bought into. So we're really holding on to things with the skin of our teeth, as it were. But IT really is the sector on the large cap screen at least. HCL Tech, Wipro, Tech Mahindra, LTI Mindtree, TCS, all of these stocks. And then there's Bharti Airtel. So telecom and IT, incidentally, both are Reema sectors. I guess, Nigel, the bulls will have these two to thank. Otherwise, the Nifty picture could have been very, very different.
Well, that's right, Surbhi. And in fact, the Bharti Airtel stock is on its way actually to move to 4 digits. So that's been, quietly moving up and holding one end up as well. The question is, since we've almost got through bulk of the day with just a 20-point cut, how do you trade the remainder of the day? Mitesh Thakkar joins us to help us out with exactly that. Mitesh, what do you make of today's trading action? First on the Nifty, as well as the Nifty Bank, and then we'll get to your stock call. So tell us about the two key indices first, the levels you're tracking.
So neither I have a negative view on the Bank Nifty, though I think it's performing better compared to the Nifty today. But around 43,850 levels or thereabouts, I would want to take some short positions, or if not that, then buy into put options. So my sense is that we had a big fall on Friday. Today's a mild bounce back kind of a day. But the index, the Bank Nifty, might find it very difficult to sustain above 43,850, 44,000 zone. So around 43,850, 900, I think, getting into some short positions would be an ideal thing. On the Nifty, I have a range-bound view between 19,630, 640 to about 19,850, 860. So I think it will be a range within that 200-point kind of a band. And the idea should be that till 19,650, 630 breaks, I think, try to buy closer to the support area and then try to exit as we get closer to 19,800. So that's the way I'll approach the indices. On stocks, I have a buy on Siemens. I think that's something, which has been trending nicely for the last few days after a correction. So buy this one with a stop at 35.50 for targets of 36.60. And MRF is on the buy list. Again, disclaimer, I have some futures position. It's a small quantity, but there's vested interest. MRF is a buy with a stop below 10,750 for targets of around, 1,10,750 for targets of around 1,14,000.
Well, the number of digits on MRF can confuse anyone right now. 1,14,000 there. But Mitesh, thank you for those strategies. Zen Technologies, it's a small company, but it's surging in trade. And this is after the company secured new export orders for state-of-the-art defense simulators. Upasa is here to tell us more about these order wins.
Well, the company has secured a new export order worth rupees 42 crores, comprising of defense simulator, and the execution timeline is about 18 months. The current order book stands at 1,500 crores, with exports contributing more than 400 crores. Earlier, we had an interaction with the management, and they have retained their FY24 revenue guidance of 450 crores, and mind you that the revenue for H1 FY24 stands at around 198 crores. For FY25, they are guiding a revenue of almost 900 crores, and EBITDA margins likely to stand around 35% is what they have indicated. They are also expecting an incremental orders worth 400 to 500 crores in FY24. So all in all, the stock remains in focus today on the back of the order win.
Okay, got that. Thank you very much, Upasana. Well, earlier in the day, we did catch up with Ashok Atluri, Chairman and Managing Director at Zen Tech, to talk about this new order win and discuss overall business momentum. Take a look.
Updated order book position is about 1,500 crores. And with respect to the execution timeline, we have about 18 months. And this will be executed in the next 18 months. So these are two things. And this is for simulators that we are... so we differentiate very largely between simulators and non-simulator like anti-drone systems. So this is a simulator order that we have got. In terms of exports and domestic, about 400 plus crores is exports, and domestic is about 1,000 crores. Yeah. We expect EBITDA to be maintained around 35%, and we expect that to continue into the next couple of years also. That's the minimum target that we have set internally, a very conservative target. We do hope that we'll do better than that. I would say about, for this year, another 400 to 500 crores worth of orders. The pipeline is there, and we think that we have a good chance of winning most of them. Yeah.
Well, the markets loved every bit of whatever Zen Technology has had to offer in the last 1 year. This year, that's the one-year chart. Look at that move, 288%. And if you look at just the calendar year, then the gain is in excess of 300%. That has been Zen Technologies and the entire defense theme. The question is, what now? What do you do with a stock like this? Deepak Shenoy is joining in. Deepak, great to have you on the show as always. Good afternoon. Have you had a look at this one, Zen Technologies?
No, while you were talking, I think I was taking a look. I have heard a lot about it. It's been relatively small as a small cap. But I think they've done pretty well from a working capital perspective. They're quite amazing. They have very few borrowings despite having relatively large business and government-based kind of orders. And, they have 200 plus crores of net cash, I think. So that way, they're not constrained on the leverage side of things. And they're also, they seem to have decent order flow. We'll have 1,500 crores in 18 months is like 1,000 crores, which is 3x what their current trailing 12-month top line is. So looks quite interesting. Honestly, thanks for bringing it to my notice. But yeah, I think should be researched some more. So I don't have too much. I'm just looking at the raw numbers. Looks quite interesting. We love the defense space in general, but the smallest of small caps have not caught so much of our attention because of size. But this might be an interesting candidate.
Okay, got that. Deepak, what do you own currently in defense then, since you say you really like the space?
Yeah, so we've owned like a Masgaon dock, which has actually gone up quite a bit. So that part, a couple of other defense names. Even some of the companies that we own in the engineering spaces have defense arms, which I think are quite one of the triggers for their growth as well. So that's part of the whole equation. But, I think it's the small caps that will actually make a huge difference going forward. So you may be right. Zen will probably do well. It's also one of the circuit stocks, right? So it ends up, not getting on our radar because it moves in circuits. So anything that goes in circuits can be a circuit on the way up and then can be a circuit on the way down as well. So we tend to get a little queasy about such stocks. That's all. That's why we don't do a lot of research.
Guys, just remember, I will remember, he owns Mazgaon Dock. Next time Deepak is in town, he's buying us all great coffee, some lunch and all that. Mazgaon's not done too bad at all itself, right? The gain is over 100%.
Deepak, we'll remember that coffee treat that we've imposed on you
Deepak, if I'm part of the treat, it's not going to be coffee. I'm not going to let you go so easy. Yeah? So that's the deal, brother.
So you need to come from Bangalore to Mumbai first for that.
Yeah. We'll catch him.
That's not so much a problem, yes.
All right, so next time come to the studio. We look forward to chatting with you face to face, for a change instead of virtually. But Deepak wanted to talk about India financials. Now, RBI has increased the risk weight for unsecured lending, loans to NBFCs. Now, this is going to hurt banks and even the NBFCs. You must have done the analysis on that. Do you want to take us through which ones get hit the hardest? And does it necessitate a change in one's portfolio because of the impact?
This is actually quite interesting because from a public market perspective, we've seen that the impact is relatively limited. Just a quick summary, I think you would have done a lot more on your show, but what RBI has done is said that the risk weight of consumer lending, apart from whatever is actually secured, is going to be increased from 100 to 125%. Remember, it was pre-COVID, I think September 2019. Prior to that, it was already 125. It was brought down to 100% at that time to promote retail lending. And recently, we've seen the last 4 or 5 years of very scorching growth of approximately 20% a year on lending to NBFCs, and which on lend, of course, to consumer loans many times, and also direct bank lending to unsecured personal loans. 30% increase year on year on credit card outstandings, which is also another form of unsecured lending. RBI is saying, listen, fine, you want to do this, but please, I'm going to increase the risk weight of them. Banks, primarily being constrained by capital, will either have to increase the cost of the borrowings for customers. So you and me, when we take a loan, we'll take a higher rate, or they'll have to deal with lower CRs. The biggest impact to me is the NBFCs in the listed space. It's SBI cards, because SBI cards is like 100% unsecured credit. They go from a 23%, I think 22% capital adequacy ratio down to 18. Now, the minimum is 15, so they still have some room. But essentially what it means is as you get closer to the 15, you have to go raise capital. That means dilution. That means the EPS gets diluted across more shareholders as they grow. This reduces perhaps future impact of whatever their growth estimates are. So I think SBI cards hits the most, but mostly it involves a lot of smaller, perhaps unlisted companies as well, which are in the BNPL area, which are lending to those spaces. So not so much impact on there's also, L&T Finance and all, which all have smaller arms, which, deal with this. But I think the big banks, not majorly affected at all.
Got that. We spoke about Zentech, a stock which has gone up 300% in the last 1 year. Another one is Newgen Software. Now, this is an IT products company, largely caters to the bank. And this one, too, is up about 285% in the last 1 year. Well, the news is not groundbreaking. The company's announced that the board meets next week on 27th, where they will consider a bonus issue. This will be the company's maiden bonus issue. Up until now, they've not done any bonus or stock split. Face value is still at 10 rupees per share. But, in terms of the fundamentals also, the company's done well. So Q1 and Q2 were both very strong quarters for the company. In Q2, the quarter gone by, sequentially, year on year, quarter on quarter, the revenue growth was about 16.5%. And in the first half of the year, the company's revenues have gone up by 31%. And the company in the conference call also indicated that Q3, Q4 is going to be fairly strong for them. Deepak, I know you're not very hot on IT per se, but have you had a look at Newgen Software?
No, now that you said, we haven't analyzed it in any detail. Again, they've been very small. We have some of the exposure in the larger IT companies, which of course have not done very well. So interesting, because we were talking about today morning about how niche software companies. I don't know if this is a niche software company, but if it is, many niches have done really well. You see KPIT in auto, you see a bunch of others in the engineering spaces. I think there's a new IPO also coming in that space. So there is actually some interesting tech pieces that I think will do well regardless of whether there's a slowdown or recession in the West. So I don't know if Neogen is one of them, but it might, if it is in some of these areas which involve either electric vehicle technology, involves engineering design from a technology perspective, or electronic design. I think these are all areas where I think there will be a lot more demand, especially for India-based companies. But I mean, I don't have a view on Neogen per se. I don't have an analysis on it.
Hi Deepak. Deepak, what do you make of these power finance companies? I recall PFC at 100. People said no, it's going nowhere. 200, going nowhere. 300. Everyone's saying that nothing's changed. But just take a look at the stock. If I remember correctly, we had done a piece in December of 2022. And at that point of time, the stock was around 130 rupees. As we speak, it's on its way to around 330 rupees. And both of them actually have done very, very well. How do you approach the stock? I mean, the best is already in the price or the best is yet to come? Because now, the loan offtake is improving, asset quality is improving, and they're pretty much able to maintain their NIMs as well. What's your take?
So the quick note over here is that these are this, the crying wolf wala argument in a way, in the sense that we always thought these stocks were good, right? They were good at 10 times earnings, then they became 5 times earnings. And then they were good at 5 times earnings, and they became 2 times earnings, right? So at that point, you're almost like, yeah, what do you do now? So, at 2 times earnings, because you've been, battered all the way down. So you're not hesitant to take it. But in the background, a bunch of things have been happening in the power finance space specifically. A lot of the NPAs have been kind of addressed in different ways because they had a lot of exposure to state discoms. And those discoms were addressed partly by an Uday scheme, partly by set off of new contracts with this tripartite agreement between the finance company, the power producer, and the discom. With a layer on top, which is actually collecting a small fee on every contract that has now ballooned to a reasonable size, which is going to be used to pay up for defaults if there are any from the discoms or from the power producers. I think this is actually a change which helps them reduce their NPAs, and they should get valued at slightly higher from a price to book or a price to earnings perspective. They're still at 5 times earnings, so it's not like they're super expensive. But and we own them, so both PFC and REC, we own them in momentum portfolios, which is purely a price-based portfolio, and the price has done really well. But the point I think over here is the fundamentals have changed marginally. I don't know how much. We'll have to see. And then the new contracts that we're talking about, 600,000 crores worth of lending that is likely to happen going forward from some of the new things that they've announced. I think that is also a huge growth trigger for them. So lower NPAs growth and low PE, I think, combination is quite good.
Okay, all right. Thanks for that, Deepak. But request you to stay with us. Just before we go into a short break, I want to pull up 2 stocks. One is Balrampur Chini. That one's moved to the high point of the day. So if we get an intraday chart of that stock, should come up for you on the screen. And on the flip side, you have Balkrishna Industries that otherwise was seeing a good rally, year to date at least. That stock is suddenly down close to around 5%. So I don't know what's gone wrong there, but that's moved now to the low point of the day. Slip into a short break on the other side. Anand Shah from ICICI Pru AMC will be joining in. Stay with us.
Welcome back. We're focusing on a lot of stocks that have been in the news flow today, and they're reacting actually quite well to it as well. Oberoi Realty is one of them. It's been up and about. Now, Oberoi is getting into the Gurugram market, making a big splash, big foray over there. It's a competitive market with DLF calling the shots for the last many, many decades. So let's see how this one goes. Sonal has the details of the foray that Oberoi is considering at the moment. Sonal.
Well, yes, it's an expansion that the company has undertaken after primarily focusing on the Mumbai market. So this looks like an interesting foray that they've made in the NCR market, where we are seeing a lot of growth and a lot of competition as well. To give you the details, the company will be buying or has acquired 14.8 acres of land in Gurugram, Haryana for a consideration of 597 crore rupees. Now, the total development potential here is 2.6 million square feet, and the company says they are primarily focusing on the luxury housing market, the one that is known where the competitors like DLF, Prestige and Godrej Properties are already there. The transaction has been under discussion for quite some time because remember, in their Q2 conference call, the company did say that they are looking at land acquisitions, maybe in Mumbai or maybe in the NCR market as well. So wherever there is demand and there are efficient price points where the buyers can buy is where Oberoi Realty is looking to enter into, and that's what they've done with NCR market. So interesting foray, and that's what the street likes this time.
Okay, got that. Thank you very much, Sonal, for the details there. Deepak, your thoughts? This is an interesting move. You know, your Bangalore guys, we were just discussing this in the morning as well. Prestige and all, they're coming into the Mumbai market. The Mumbai guys want to expand into Delhi. So it's, a pan-India presence. I guess that's what people are looking at least, real estate developers are looking at. Your thoughts on Oberoi?
It's interesting. I mean, the cycle's actually the same in the 90s, I think, and the 2000s. DLF actually came to Bangalore once. It did not do much, and then the Rahejas didn't do quite as well in Bangalore as they had done in Delhi. The Unitech also came to Bangalore after a very successful Gurgaon market, when then things didn't work out. So I think this geographical move is not easy, and also there's a lot of very different markets. Mumbai is a completely different market compared to Delhi, which is primarily investor driven. So we'll have to see how an Oberoi, which is a different kind of a company, will deal with the vagaries of the Delhi market. Which, I mean, you'll see the guys who succeeded in Delhi have not really made a mark so much outside of it, and I think it applies from a city perspective. So I think I'll wait and watch rather than get excited about this opportunity. Maybe they'll change the game and things will be awesome, or we'll see whether they'll be left with bruise marks. So it will take 3-4 years for that to come out. But I think I'll wait to see the outcome of that before making a decision. Okay, all right. Deepak, I want to know whether you have a view on any of these holding companies. Tata Investments is suddenly up close to 15%. Big move is what we're seeing out there. Sumit Securities, I think that's the other one that's moved well. And in the past, you've seen Maharashtra Scooters, the erstwhile Sundaram Clayton as well did very, very well. Any view on any of these holding companies that come on your radar? I'll tell you what, a few months ago, I put out a piece. And normally when you start talking about holding companies, it's the peak of the bull market. From there, most of these stocks actually have done very, very well. In the past, I've seen when you talk about holding companies, sometimes things top out. Your take? Quick note here is that SEBI has put a consultation paper about voluntary delisting of such holding companies. Now, one of the notes in that paper says delisting. It doesn't use the word voluntary, because they say that they should be delisted according to the delisting guidelines, but I couldn't find anything that forces them to be delisted in the first place. Yes. But assuming that they want to delist, I have this problem understanding why they would delist at a higher price, because the regulation actually says that you should delist by effectively giving the holding company shares, the shares that the holding company holds, give them to the public market shareholders and delist the holding company, which is what Tata Investments would have to do if it were to try and delist. But I'm not sure. I don't think Tata Investments wants to delist. They hold about 40 or 50% of their portfolio is Tata companies. The remaining 40-50% is actually public companies. So they are like a mutual fund of sorts, because they just own all these companies, and they typically trade at a 40 to 60% discount. Now the discount has fallen to 20%, apparently because of this circular. I don't think there is any promoter who owns a listed holding company that actually wants to delist and is happy to pay a higher price for it. So I don't think this regulation will change anything in that respect. So if it's because of that people are getting excited, I think that's probably a little premature. On the other hand, if people are just getting excited because it's a holding company, it may be like you said, the last part of a strong stock rally. Again, I think that's also going to end up in disappointment, because holding companies of promoter-owned companies, they do not want to ever sell their shares. You will never see them sell their shares. And why would I pay a premium for a company who does not want to sell its shares? So at best, I will give it a little bit for the dividends that it gets. So a 40 to 50% discount is a given. So I don't think this will last meaningfully. And as my family owns a little bit of Tata investment, so slightly biased there.
Deepa, point well taken. Thank you very much for joining in. We'll get into a very short break. We'll come back and talk more about the markets. About 35 minutes left for us to wrap up the day.
Saddest part was it wasn't even a fight. It's okay. Like, it doesn't work. It
No,
was
I
like a
feel like if it
nail-biting
wasn't-
match that you watched till the last 2 overs.
No, I think it would have been harder to digest.
Oh,
What is going on here? Arre? Okay. Okay.
going on in the break.
I think overall as an organization, we grew at about
Welcome back. Well, the markets are sitting with a bit of a cut, but we're holding at around the 19,700 mark, though there are plenty of stocks that are doing very, very well. You have stocks like Moil that are up more than 10%, so big move being seen out there. I recall the stock listing close to 10, 12 years ago and listed more than 350 rupees. Now the stock is at around 300 rupees. So some of those big underperformers, I think Copran is another stock that popped up in trade. So that one as well should come up for you on the screen. Copran is the stock we're talking about. And Skipper as well. So some of these underperformers actually are up between 8 to around 10% in today's trading session. Anand Shah, head of PMS and AIF investments at ICICI Pru, joins us on the show. Hi Anand, good afternoon. Thanks so much for joining in. Well, I'm looking at a contra fund and a couple of other funds as well. It seems that on the metal basket, you have quite a bit of exposure. You know, Godavari Power and Ispat, you have Tata Steel, you have Hindalco, so ferrous, non-ferrous as well. Where do you think we are in the cycle? Are these old investments that you have made, I mean, a few months old, older, or are you adding as well at these levels? Because one school of thought is, if China unlocks, then the best way of playing that China theme will be via metals. Your take?
Hi, very good afternoon. Thank you for having me here. Yeah, so we've been owning these names for a while now, and almost 3 years, and we've been still adding for our clients as and when there's an opportunity. The point being, a few things have changed for good, and one of that few things is actually China in terms of the pollution clampdown. Very honestly, it's not only about metals. Many energy intensive or fairly polluting industries in China, there has been a severe clampdown. Their competitiveness in manufacturing these and exporting to the rest of the world has reduced over time. And that's one positive. The other positive within the metals industry is been decarbonizing. So the other inflation that you will see in metal, and you are already seeing inflation in metal prices in per se, that steel has become fairly expensive over last 3 years, and so much so, even the aluminum. And to that extent, that's a reflection of that the world will decarbonize. The world will have to use the sources other than coal to make these metals. And that will involve not only OPEX, significantly higher OPEX, but also higher CAPEX. And to that extent, what we are seeing, that over a decade, the prices of metals would be higher. At the same time, there are also bottom-up reasons for many of these companies. They made wrong acquisitions, wrong investments a decade back. A lot of course correction has happened. Their balance sheets are improving, the return on equities are improving, and most importantly, the incremental capital allocation, that is something which we have been watching them very closely. That also seems very prudent. So both top-down and the bottom-up reasons to own these names.
Anand, afternoon. What's the top-down call you are taking at ICICI Pru when it comes to the global market? Because it does appear to be turning a little more supportive with, the bond yields where they are, the possibility of rate cuts next year, crude prices easing off from the levels that it was. So what's the top-down macro call, very quickly?
I think macro continues to remain challenging. They have been very challenging for the last 2 years, especially post the Russia-Ukraine fallout. Inflation has gone up, interest rates have been inched up, and the dollar is strengthening. And I don't think that's, so far, it looks like it's topping out. Maybe over the next 12 months, we might have reasons to be happier that, we've seen the peak of interest rates in US, and to that extent, peak of dollar, and then maybe the FI inflows can come back into the country, but there are no early signs yet. I think the US economy remains very, very strong. The fiscal deficit is also fairly wide in US, and that doesn't give you confidence that Fed is done with. And to that extent, this is an era of higher interest rates for longer. The only fear is it should not go further higher. I think that's the only thing we are watching out.
Okay, got that. Anand, hi. Good afternoon. So tell us, what was your big takeaway from the earnings season, Q2 earnings, and were there any positive surprises, anything that forced you to take a fresh look in terms of a theme, sector, certain type of companies perhaps?
I think we've been fairly happy with the results in the sense that we've been holding this view that the trend has changed. For almost a decade since GFC, or maybe 1.5 decades, you were comfortable owning consumer-facing businesses and avoiding all the B2B businesses, manufacturing allied, utilities, or even the lenders to utilities. All those were fairly underperforming or not performing at all. But if you're owning a consumer-facing businesses, you're benefiting from the deflation exported from China, whereas manufacturers suffered. So that's the one view we have been taken last 3 years back, that trend has changed. China, instead of exporting deflation, is going to export inflation, which would be negative to the consumption basket, but positive for the manufacturing basket. So continuing on that, for last 2-3 years, we have seen the profit growth rate in B2B segment is almost thrice better than the consumer segment. We are seeing profit growth in both. So one good news is that India Inc. in general is getting good profit growth rate for last 3 years, which has been driving the markets. But within that, the basket of B2B has been doing much better than expectations versus B2C basket. Q2 has not been very different. Even within banking, if you see, the erstwhile corporate banks have performed much better than the retail banks, and so much so many of the manufacturing and manufacturing allied businesses continues to do very strongly on top line growth rate. Margins have improved as the commodity price pressures have come off. So that's helping both manufacturing entities as well as to some extent consumer facing businesses.
Okay, all right. Anand, where are you placed on these gold financiers? There was a big market. And out there, in fact, you only had Muthoot and Manappuram that were doing very, very well. You have some exposure in the gold financer space. But, there are other banks, when I speak to CSB, when we speak to Federal Bank as well, smaller banks out there, they have seen this opportunity, Canara Bank, and they are penetrating into the market. How are you placed on the gold financiers from your knowledge? Do you think they still have scope to improve, or would you rather play the banks? I ask this because I see in your holding, you have Muthoot Finance.
No, indeed. So the return on equities that this business made was very high for a very long period of time. Banks have sort of ignored a very, very profitable segment because the risk of losses are very little. At the same time, the yields are very higher. So I think this is one segment which was very profitable for these financiers. Now they have kept the ROE very high, which is in turn attracting competition. So you're right that all the banks, by only a few select banks, all the banks are looking at least within their own customer segment. If somebody needs a gold loan, they would be more than happy to provide that. And to that extent, there is increased competition, which in turn means that the lower return on equity. But that doesn't take away the attractiveness of the business. I think even at that lower return on equity, it will be still better business. And to that extent, the prospects remain strong. The other thing which is also leading to a lower growth in gold loan business is also fairly easy availability of the unsecured personal loans. I think that is something that has changed last week. I think as the risk capital or the risk weight goes up, the unsecured personal loan, I think there should be less supply of that easy money available, and that can also lead to some bit of growth coming back in the business.
Anand, while you don't make many changes on a day-to-day basis, but over the last 3 months, have you made any changes in your portfolio, increased the weightage on any of your holdings, pared it down just to rationalize the holding, any additions, any deletions? 3 months.
I think more recently, if you ask me, we've been always liking manufacturing allied, and one of that allied business is utilities. I think very clearly there is an increased, I would say, awareness that the electricity demand is growing much faster than anticipated, and there is going to be a deficit. That is helping both the utilities as well as the utility financiers. So even somebody who has been expert or specialized in funding of these utility financiers, those are also, they're seeing strong recoveries. First and foremost, all the stranded power plants, there are enough maybe 1, 2, or maybe 3 bids for many of those. So a lot of your NPAs getting resolved. But at the same time, the demand outlook looks strong, both on the thermal side, but more importantly on the renewable side. And those are also the some areas that we are finding attractive valuations. as well as good growth. Those are some of them we have again added in.
And any deletions or changes in weightage?
I think we've been sort of very stable in our portfolio. We haven't found any of our companies where there has been significant disappointment. So to that extent, a large part of the portfolio remains the same for almost last years.
Okay. All right, Anand, we will leave it on that one for today. Thank you very much for joining in and giving us your thoughts on the market. We do have to take a very quick break on that note. We'll come back on the other side. Actually, before we take that break, I think we can quickly get to Mitesh. We do have Mitesh with us. So let's find out what can be some last half-hour trades. And then we'll get you more. Mitesh, so how's it looking? Nothing on the index. Any new, fresh stock trades?
Nothing on the index. In fact, the bank nifty has tapered off a little bit and the nifty remains where it was. So not much happening over there. On the stocks, we can take some STVT, VTST kind of trades. And the one which I like is Persistent. It's trading in the day's high and showing good strength on the chart. So there's a higher possibility of it showing some continuation. So buy with a stop at, or VTST with a stop at 64, 65 and a target of 65.30, 65.40 on the upside can be looked at. And a similar setup is happening on the charts of Policy Bazaar. Disclaimer, it's part of my portfolio, so I have vested interest. But Policy Bazaar, I would recommend a short-term buy with a stop at 818 for targets of 850.
You've given a lot of buy calls on IT names through the course of the day, Mitesh, and the latest one is given. Here's what we'll do. We will slip into a very short break on that note. As we do that, we'll get you some market opinion. Earlier today, we had a chat with Sanjeev Prasad, MD and head of Kotak Institutional Equities, to discuss his views on the market. He believes the markets there are three distinct markets in right now, what we have on our hand. You've got mega caps, you've got large caps and quality mid caps, and then you've got small caps. Listen in to what his views are and the way forward.
On the portfolio part, really, we haven't really changed much. On the margin, we have changed a few things here and there. But as I said, honestly, it's further really to find too much of value in the name. So we are sticking with the same stocks, largely the large cap banks, some names in pharma, healthcare services, which I talked about earlier, overweight in consumers, underweight in IT, and Reliance and Telecom are fine. So that's broadly the mix of stocks which we are having. We also have some capital goods stocks and real estate, although I'm just struggling with the way the stocks are up over there. Yeah, ultimately, as a general principle, you have to look at stocks more on a bottom-up basis and figure out whether there is any real value in the stocks based on whatever is the gap between the fair value of the company or the stock and the price. And we're just looking at prices and trying to figure out, that this is a good stock to buy or not buy. And that's a foolish pursuit, which unfortunately many people in the market have been doing, just looking at stocks and assuming which are going up and assuming there is value in the stocks. On a portfolio perspective, I think it's better to be the large caps now. The large caps, when I say it's mostly the mega caps, where at least we can see some value in some of them. If you look at the consumption-related sectors, whether staples, discretionary durables, etc., what we are seeing is a big change in the operating environment of these sectors, in the sense that the traditional strengths which these companies had, whether it was policy control or distribution, and distribution ultimately in India was largely through the general trade channel, whether it was very popular brands, etc. What we are seeing is a change across all the traditional strengths of consumer companies. So, number two, distribution modes are no longer that valuable as they were earlier, because you are seeing a big change in the distribution mode itself. So if you put all this in the context, there is a lot of disruption coming. If you look at the real estate market in India, that was pretty much dead between 2012 all the way till 2021. Between 15 and 21 prices, most of the markets didn't go anywhere. Whether you look at the NCR market, Innova market, Pune, Bangalore, except for Hyderabad, prices have been pretty flat, which means that in real term, prices are actually down, affordability is up significantly. So the number one factor that there is a lot of pent-up demand. Number two, affordability is great at this point in time. And number three, prices have just started to move up. Over the last 12 months, 18 months, we're starting to see some price movements in some of the markets. And that is probably the trigger for some of the households which have been sitting on hands, waiting for price to move up to start looking at real estate more favorably.
Just a shade below 19,700. That seems to be the way the markets are going to likely close up for trade, with a little bit of green on the mid-cap index, though you've got more declining stocks versus advancing stocks. If you pull up the advance decline ratio, when we started trade, there were more gaining stocks. The two lines merged, and now you've got more stocks currently in the red on the NSE versus the BSE. There you have it. A little bit of, the declining stocks have put their head above the advancing stocks. But one stock which is on our radar is Metropolis. We had a chat with the management earlier today, and they said discounting from new age players has reduced. The company is witnessing reduced traction in metros. However, they are optimistic on the western region. Amira Shah, promoter and MD at Metropolis Healthcare, told CNBC-TV18 the company is looking forward to a better H2 compared to H1. Listen in.
I think overall as an organization, we grew at about non-COVID, which was the core business, keeping aside any COVID contracts, grew at about 13% Q2. which was mostly led by volume, about 10%, and about 3% was led by a revenue per patient increase. Actually, the Western region grew much faster for us than 13%, which are actually our core markets. We have seen that at least for Metropolis, we have gone on to go back to pre-COVID growth levels. And margins are also very similar, just adjusting for the additional expansion that we are doing, which we were not doing pre-COVID in terms of lab expansion. So I think we are pretty much back to pre-COVID levels from a growth perspective. And H1 for us is usually a little bit slower growth. H2 tends to be a little bit better. While Q3 is obviously not the best quarter, it's probably the lowest quarter of the year, but Q4 tends to be the best quarter in the year. So look forward to a better H2 as we go forward, even better. But I think we are feeling very positive about the years ahead.
Well, that's management of Metropolis talking up the second half of the year, and they're sounding pretty confident as well about that. Quarter 3, they say, will be more or less subdued, but Quarter 4, they expect things to ramp up again. Well, let's get in Hemang Chani, who joins us. Hi, Hemang. Good afternoon. Thanks so much for joining in. Hemang, I wonder your view on Bajaj Finance. In the last 30 minutes or so, that stock has seen a sharp downtick. In fact, it's moved to the low point of the day. And over the last few days, the news piece that's coming out is not very, very good news. First for the company and then for the sector on the whole. What's your take?
Yeah, good afternoon, Nigel. So I think the recent statements and notifications by RBI with an intention to curtail the growth in the consumer loan segment and the unsecured loans per se, where there is a bit of a stress. As we all know, Bajaj Finance is a large player there. So since the regulator is a little, aggressive in terms of putting those curbs, there is going to be some sort of a negative impact, at least in the near term. So I think on some of these NBFCs, you would see underperformance come through. But as we all know that if you see any meaningful correction, let's say about 5 to 7%, people would really want to participate in a name like Bajaj Finance. So I think in the intervening period, it would be good to move from a Bajaj Finance to maybe some of the banks. But if the stock's correct, definitely it would provide a great entry point.
Hema, Titan, you're looking at Titan and they've opened some stores in the United States. Have you had a chat with the management about their international expansion? And have you heard more on how, what could be the expected revenue from this expansion that they've planned?
Yes, Rima, as we all know that this Diwali season has turned out to be extremely good for the jewelry companies, and even the quarterly update that Titan gave out was very good. What really came as a big surprise was that the international foray and the stores that they've opened recently have received extremely good response. And my sense is that the market consensus is not building in a very high growth when it comes to the global footprint. So early days, but I think the growth on a lower base would be in the range of about 30 to 35%. So I think something like Titan, where you have this kind of a growth opportunity from the domestic market, surely provides a great entry point for investors.
Okay. Hemang, your thoughts on a lot of this excitement around the Tata Technologies IPO and just the whole space and valuations on mid-cap IT in general. I mean, in a market right now, IT is actually the lone pillar that's providing some semblance of support. So what do you think of this particular space, this ER&D space and the valuations? And what would you rather buy, large-cap IT, mid-cap IT, or are you avoiding completely?
Hemang,
yes, we can hear you now. Yeah.
Yeah. So I have a slightly different view when it comes to Tata Technology IPO from the consensus. I feel that it's a mix and match of multiple companies. And though on the face of it, the numbers look great, I think this ER&D and the mobility and all, I don't see any meaningful business model or valuation comfort when it comes to that. I think the primary purpose appears to be giving some sort of an exit to Tata Motors. So I am not too excited by that. But I think mid-cap IT as a space, yes, I do find that some of the companies like Birlasoft, KPIT, Persistent, I think there is a good, trigger in terms of the quarterly results and the growth expectations, given the revival in the US markets.
Hemang, what's your view on real estate stocks, particularly Oberoi Realty? Now, they announced they're going to be going into the Gurugram market, and the street read that positively. The stock was up 4% earlier, actually. As we speak, I think it's more or less flattened out. Your view on Oberoi Realty's foray into a new market, and also the incumbent out there would be DLF. How do you approach that stock?
Clearly, Nigel, real estate is the sector, good sector for a lot of, players. Good growth momentum, new triggers keep flowing in terms of, sales, newer markets. Oberoi also, there is a possibility that in the next MSCI rebalance, it could also get into it. The only issue is that the stocks have run up big time. So I would be more comfortable, if there is a little bit of cool off. The core story continues to remain great. I think Oberoi or Brigade or Loda, I think these are the stocks I like, but I would really prefer to buy at small dip.
By the way, pull up Honasa Consumers intraday, chart. The stock was up 11%, and now from a high of 375, almost there, the stock has fallen close to about 26 rupees. There's been a sudden fall in Honasa Consumers' share price. The company will be declaring their Q2 numbers next week. So I think on Wednesday is when they will be declaring their numbers. Yes, this week, on the 22nd November, the company will be declaring their numbers. Hemang, any reason that prompted an 11% up move? It's still holding up above its issue price. And what led to the sharp decline? Any news that we missed?
So Rima, typically our experience with new listings in Paytm and Zomato and all is that it would be good and sensible thing to let the stock settle down and see maybe 2 or 3 quarterly numbers, because there is always be a disconnect between what the company has told at the time of IPO or what the consensus is versus what they actually delivered. So it's been a little expensive stock. It may have gone up because of some institutional buying. I don't think there is any fundamental news flow as such, but typically I would avoid getting into it at this stage.
Okay, all right, Hemang, we will wrap it up on that note then for this afternoon. Thanks very much for joining in. Always appreciate your time with us on the show. Well, we do have to get down to the close of what's been a really quiet session. Not much moving on the index. The bulls will like the fact that at least the ground did not sort of give way, and that intraday dip that we had, a very sharp one at around noon, that kind of got bought into, at least in parts. So let's look at the Nifty. We're still ending with a cut of about 32, 33 odd points. So let's track the weakness first. Financials are still looking fragile. That's a very clear takeaway from today's trading action on the Nifty and even beyond. On the Nifty, you've got, of course, Bajaj Finance, SBI Life, some of the banking names like Axis Bank to look out for. These were some of the weak sort of parts of the index. ICICI Bank also ending flat. So banks could not retain their gains. That's point number one. Point number two, you didn't have too much of support from the heavyweights, the big boys. Lever, ITC are ending down about 1% thereabouts. Rough day for L&T, 0.5% down there. Reliance couldn't add to the tally. It's ending absolutely flat. So overall, consumers, by the way, weren't a very good-looking space today. A lot of profit taking on an Asian Paints, for instance, after the big move that we saw on Friday. What held up the other end of the market was really IT. That's the one lone sector that stands out. Wipro, HCL Tech, Tech Mahindra, all these names managed a little bit of green. And let's not forget the two Nifty winners, Divi's and Bharti Airtel. Guys, I mean, these were the ones that were doing some of the batting, but it reminds me of Sunday. We don't want to go there. But just,
No, it's done.
Unfortunately, not enough, not for the Nifty.
Let's talk about a couple of winners then for the broader market. So we don't remind us about Sunday. We look forward to the next 4 years. Talbros won a big order, stock up 20%. Pratap Snacks, in the next few hours, we'll get to know who are the parties to that large trade. But that stock as well got locked up by close to 20%, 5% equity changing hands out there. Goldium, after a while, the stock has spiked up. One of those plays on the diamond space, so that stock as well up close to around 15% lab-grown diamonds. You had SML Isuzu that saw a big correction actually from the recent peak, but that stock as well spiked up. Skipper, I don't know what the street is reading out there, but that stock, in the last 4-5 months is actually nearly up close to around 60-70%. So that one was up close to around 12% as well. And Kolte Patel as well. All the attention was on Oberoi Realty as well as DLF. Kolte Patil was up more than 10% in today's trading session. So some of those big gainers from the broader markets.
Well, ITI also caught your attention, 7.5% higher on that. NetWeb was up close to about 1.2%, potential beneficiaries of the IT hardware PLI scheme. So ITI particularly, which is looking to manufacture its own laptops, made in India laptops, was up close to about 7.5%. Kaynes Technology also is qualified for the hardware PLI scheme, but the stock sulked 3.5% down. Plus, there was that fundraise announcement coming through on Kaynes Technology. Other notable gainers include Newgen Software, 5% up. Bonus issue announcement to be considered next week. Zentech on the back of order wins. Metropolis was up nearly 1.7%. SBI Cards got hit hard on Friday, was down close to about 5%. But today it's managed a bit of a recovery. And BSE, Bombay Stock Exchange, that's the one which lost 5.6% on that. And on pretty large volumes, it's had a one-way run-up year to date. BSE has been up 300%. But today, it gave up some profits. By the end of it, the Nifty is going to close below that 19,700. The mid-cap index has a fractional gain. With that, it's a wrap and closing bell from the entire team. Thank you for watching.